Here is something nobody tells you about your 40s. This decade is the most dangerous one for your financial future, not because the risks are bigger, but because the illusion is more convincing. You are earning more than you ever have. Your career finally looks like something. Your name carries weight in the room. And yet, quietly, the gap between where you are and where you need to be is either closing or widening. And you may not feel which one is happening until it is too late to change it. The people who retire with real freedom did not get lucky in their 50s. They made specific, deliberate moves in their 40s that the average person either skipped or delayed. In this video, I am going to walk you through the 8 financial milestones you absolutely need to hit before you turn 50. Not vague advice. Specific targets, specific numbers, and the exact reason each one matters at this stage of your life. Let's get into it. The first milestone is your retirement savings benchmark, and it is the one that determines whether your 50s become an acceleration phase or a desperate scramble. The target is 6 to 7 times your annual income saved for retirement by the time you approach age 50. The median income for Americans in their early 40s is around $71,600 a year. 6 times that is roughly $430,000. 7 times is about $500,000. So we are talking about a target range of $430,000 to $500,000 in total retirement savings by your late 40s. Now here's what those numbers actually mean for your future. Let's say you hit $450,000 by age 40. At an average annual return of 8%, which is consistent with long-term historical stock market performance, that $450,000 grows to over $3 million by age 65, with 0 additional contributions. But of course, you are not going to stop contributing. If you continue putting in 15% of your income monthly, that same $450,000 becomes over $4.1 million by retirement. Even at a more conservative 6% return, you are looking at comfortably over $2.5 million. The math works powerfully at this stage, but only if you have the base in place. The 2 most important actions here are both about maximizing tax-advantaged accounts. First, your 401k. The 2026 contribution limit is $24,500. If you are 50 or older, you get an additional $8,000 catch-up contribution, bringing your total to $32,500. If you are not yet at the maximum, your 40s is the decade to close that gap. The compounding time is shorter than it was in your 30s, but every dollar invested now still has 20 or more years to work for you. Second, if your income qualifies, maximize your Roth IRA. The 2026 limit is $7,500. Contributions are after tax, meaning every dollar of growth and every dollar you withdraw in retirement is completely tax-free. For someone at their peak earning years, which your 40s almost certainly are, the Roth is uniquely valuable because it protects you from any tax environment that might exist when you are 65. Future tax rates are uncertain. The Roth eliminates that uncertainty entirely. This next milestone is one of the most important and one of the most violated at this exact stage of life. Let me show you what it looks like in practice with 2 people I know well. My neighbor Marcus is a senior director at a tech company. He pulls in around $280,000 a year. The neighborhood he lives in, the car he drives, the vacations he takes, everything signals success at every level. His investment portfolio? Almost nothing. He has been earning well for over a decade, and virtually none of it compounded. Now contrast that with my friend Derek. Derek teaches high school history. He makes $63,000 a year. He drives a car he bought used 6 years ago and paid cash for. His lifestyle looks almost identical to when he started teaching. His investment portfolio? Over $400,000. That number shocked Marcus when he found out. This is not a rare outcome. It is the most consistent pattern in the data on how real wealth is built. The research is clear. The single variable that determines net worth over time is not income. It is the gap between what you earn and what you spend. Marcus's gap is nearly 0. Derek's gap is enormous. The math does the rest. Your 40s are the decade when this discipline is simultaneously most threatened and most important. The income is real. The social pressure to match it with lifestyle is constant. The neighborhood you can now afford has a certain standard. The schools, the cars, the restaurants. Every signal around you says it is finally time to live the way your income suggests you should. That is exactly the trap. My practical rule? Whenever your income rises, a raise, a bonus, a new job, immediately redirect at least half of that increase into investments before your lifestyle has any chance to absorb it. Your lifestyle still improves. The other half is genuinely yours. But your wealth compounds in parallel rather than being replaced by spending. The emergency fund advice you heard in your 30s, 3 to 6 months of expenses, is no longer adequate in your 40s. The expenses that appear in this decade are categorically different in scale. A roof replacement, a teenager's braces, a parent needing medical support, an unexpected job loss in an industry going through restructuring. These are not rare events. They are predictable costs of being 40, and they arrive at a size that a standard emergency fund cannot absorb. The target in your 40s is 9 to 12 months of essential household expenses. The median household in this age group spends roughly $7,000 to $8,000 a month on core necessities. That puts your target at $63,000 to $96,000 sitting in liquid reserves. Most Americans in this bracket have nowhere near that. Research consistently shows median emergency savings for households in their late 30s and early 40s is under $10,000, which for many households is less than 6 weeks of actual expenses. That shortfall means one unexpected event, not a catastrophe, just a large unplanned bill, pushes the average family onto a credit card at 20% interest, or forces them to pull from investments at whatever price the market happens to be offering that day. Both outcomes are expensive. Both are entirely avoidable. Keep this fund in a high-yield savings account. Rates today are in the range of 4 to 4.5% annually. On a $96,000 emergency fund, that is over $4,000 a year in interest, money that works for you while it waits. If you are still carrying consumer debt in your 40s, car loans, student loans, personal loans, credit card balances, this is the decade to eliminate all of it. Every dollar going toward interest on consumer debt is a dollar not growing in your investment accounts during the years when compounding has the most remaining runway before retirement. Here is how to put a dollar amount on that cost. Imagine a household paying $1,000 a month across their various consumer debts. If they aggressively pay off that debt 5 years early, they free up $60,000 in cash. That $60,000 invested at an 8% average annual return over 20 years grows to approximately $280,000. Choosing to aggressively eliminate debt in your 40s is not about living small. It is a decision worth nearly $280,000. The one I want to call out specifically is the car payment. The average new car payment in America right now is around $650 a month. If you redirect that $650 into investments instead of a car loan every month for 10 years, you accumulate nearly $120,000. A reliable 5 or 6-year-old vehicle purchased outright eliminates that payment permanently and turns a liability into a compounding asset. The goal entering your 50s is simple: one debt remaining, the mortgage. Everything else, zero. A single income source is fragile in a way that becomes very visible in your 40s. Layoffs in this decade are frequently aimed at the most expensive positions on the payroll, which at the peak of your career is you. The income source it took you 20 years to build can be eliminated in a single conversation. Multiple income streams do not remove that risk. They change the price you pay when it happens. The goal is not to build a side empire while running a demanding full-time career. The goal is to develop income that leverages the professional knowledge, expertise, and network you have spent 2 decades building. Streams that require real effort to set up, but only moderate maintenance once they are running. I have a former colleague named Ray, a software engineer for 18 years. He spent 6 months building a course on a niche technical skill most senior engineers in his field ignore. He did not quit his job. He did not overhaul his life. That course now earns him around $2,800 a month in mostly passive income, $33,000 a year. And because his primary income already covers his household expenses, every dollar of that $33,000 goes directly into investments. That is the model. 1 or 2 decades of expertise already has market value. The question is whether you package and distribute that knowledge in a way that generates income from it. Consulting by the hour for skills you already have. Rental income from a property that cash flows each month. A dividend portfolio large enough that distributions become a meaningful income stream. Content that teaches what you know to the audience that needs it. None of these require you to leave your primary job in the early stages. All of them require real effort up front, and every one of them changes your financial resilience in a way a raise at your day job simply cannot. This milestone is the one most people in their 40s skip, and the consequences fall not on them, but on the people they love most. My uncle passed away unexpectedly a couple of years ago. He had done more estate planning than most people, more than almost anyone I know. But some documents were outdated. A beneficiary designation had not been updated after a major life change, and the executor he named had passed away before him with no replacement designated. The result was that the people grieving him had to spend weeks navigating legal and administrative complexity during what should have been a time focused entirely on each other. Estate planning is not about death. It is about protecting the people affected by your death or incapacity from complications that are completely avoidable with a small amount of preparation. At minimum, a complete estate plan in your 40s covers 4 things. A will that specifies exactly how your assets are distributed and, if you have minor children, designates a guardian. Without it, the state decides based on formulas that may not reflect your wishes at all. A living will that documents your medical treatment preferences if you become unable to communicate them yourself. A healthcare power of attorney that designates a specific person to make medical decisions on your behalf. And updated beneficiary designations on every financial account. Retirement accounts, life insurance, bank accounts. A beneficiary designation overrides what a will says. An outdated one, a former spouse, a parent named when you were 23, can produce an outcome no will can reverse. Work with an estate attorney. The cost of doing this properly is small relative to what you are protecting. The cost of incomplete documents is borne by the exact people you are trying to protect. According to the U.S. Department of Health and Human Services, approximately 70% of Americans who reach age 65 will need some form of long-term care during their lifetime. The current cost of a private room in a skilled nursing facility runs between $9,500 and $13,000 a month. 3 to 5 years of care, not an unusual duration, totals $300,000 to $500,000 at today's prices, and that number will be higher in 20 years. Medicare does not cover long-term care in any meaningful way. Standard health insurance does not either. The default plan for most Americans is to spend down their assets until they qualify for Medicaid, which only kicks in after savings are nearly exhausted. For someone who has spent their 40s building a retirement portfolio, one health event in their early 70s can erase a decade of financial discipline in 2 to 3 years. There are 3 ways to manage this risk. Long-term care insurance, purchased in your early 50s when premiums are lowest and health qualifications are easiest to meet, pays defined benefits for care without depleting the retirement portfolio. A hybrid life insurance policy with a long-term care rider gives you both a death benefit and care coverage. If you need care, it is there. If you don't, the benefit passes to your heirs. Or self-insuring through a sufficiently large retirement portfolio. But this requires honest math about what sufficient actually means given projected care costs. The right answer depends on your situation. The wrong answer is no plan at all. The time to make this decision is your 40s, so that you can deploy the solution in your early 50s while options are still open and affordable. The final milestone is the one that separates people who are wealthy from people who simply earn a lot. Those who are truly building wealth in their 40s begin shifting their relationship with time. They stop optimizing purely for income and start optimizing for hours. The math that drives this shift is straightforward. A $1 million portfolio invested at 8% generates $80,000 a year without you working a single hour. Money can generate income indefinitely. Time cannot be recovered under any circumstances. It does not matter how much you earn. Buying back time looks different for everyone. Paying a house cleaner to free up 8 hours a month. Paying for TSA pre-check to recover hours across a year of travel. hiring a lawn service, paying for grocery delivery. Each of these is a transaction where you exchange a small amount of money for a resource you can never earn back. And the math almost always works in your favor. If you earn $120,000 a year, your time is worth roughly $60 an hour. A house cleaner at $30 an hour who frees up 8 hours a month costs you $240 and returns the equivalent of $480 in time. That is a trade you should make every single time. The deeper point is this. Your 40s are the first decade where most people have enough resources to make these trades. But they don't. Because they have spent so long optimizing for accumulation that they have never stopped to ask what the money is actually for. Start asking that question now, while there is still time to act on the answer. Those are the 8 milestones that determine whether your 40s build the foundation for a genuinely free retirement, or quietly close that window. Retirement savings at 6 to 7 times your income and compounding hard. Lifestyle held below the pressure of your rising earnings. An emergency fund large enough to handle what this decade actually throws at you. Consumer debt eliminated so your cash flow is fully yours. Multiple income streams reducing your dependence on any single source. An estate plan that protects the people you love. A long-term care plan in place before the options get expensive. And your time bought back from the things that are not worth it. The decisions made between 40 and 50 will shape every decade that follows. Do not let this one go by on autopilot. Tell me in the comments, which of these 8 milestones are you working on right now? If this video helped you see something differently, hit subscribe and the bell so you don't miss what's coming next.